It's a huge week for the consumer. Retailers like Macy's, Walmart, and Tapestry all reporting results this week. We also get a slew of economic data, including the Consumer Price Index, retail sales, and consumer sentiment. But with trade tensions heating up, the consumer could get crunched. Macy's CEO Jeff Gannett telling our own Courtney Reagan last quarter, if tariffs are levied on the remaining $300 billion worth of goods, which looks like is happening now, it could, quote, really impact our categories. It's not in guidance. And when you do the math, it is hard to find a path through that would not impact customers. So with that said, now that we know the tariffs are coming, what do you think of retail?
I don't like retail for that exact reason. The one thing that retailers have been doing across the board is they've been absorbing some of these tariffs, and they've been keeping prices low. China's actually kept prices low, but now it's getting to a point where you can absorb 5%, 10%. But at 25% tariffs, if we start to go 10% to 25%, that becomes a real problem. Prices start to rise, and sales are going to go down. So any of the ones like Walmart, that chart looks terrible. Any of those names that have exposure to that, to me, are just no touches.
So I think there's certain pockets of opportunities within retail. So one of the companies we like is TJ Maxx, right? So let Kohl's and Macy's, they can pay the tariffs on all these goods that are coming in. They're not going to sell them. Those goods are then going to end up over at TJ Maxx, and they will sell them because people love going there for that treasure hunt experience. Beyond that, I think there's also an opportunity in companies like Lulu. I mean, that's a Canadian-based company, not going to be hit by the tariffs. Strong brand loyalty. I mean, I was just on vacation in California. All my girls wanted to do was go to the Lulu store, right? So, I mean, if people go there, they continue to buy it. Even if prices go up, they're going to continue to spend money there.
There's also, I mean, you're making the point earlier that there's sort of the staple retailer, which is doing okay, and then there are the department stores, which are not going to be able to weather the tariffs very well.
Yeah, so, I mean, listen, we don't even have to talk about the XRT. It's year after year for the last 5 years, one of the worst charts of all the sectors of the market. It's a disaster. You know, the issue about some of these big box guys like Walmart and Target and Costco is their margins are really narrow. I mean, like, so that's a big issue. That being said, I'd rather be there. Just one other point I think it's really important to think about. When rates, we're just spending a lot of time talking about rates. What are we seeing in autos? What are we seeing in home sales? We're seeing them down year over year. So when you start thinking about where is the strength of this consumer that 70% of our GDP is on, I don't see it in the same light. I mean,
I just think the operating margin in Walmart has been priced to perfection. I think there's going to be pressure there. And I think if you look at us at Best Buy, that's a name always trades cheap. Guess what? They are the ones, to me, that are in the greatest line of fire from this trade war.
Let's turn to the charts. Consumer staples and discretionary, they've been among the S&P 500's best performing sectors in 2019. But despite the gains, the chartmaster says there are plenty of potholes on Main Street. Carter's over at the Plasma. Hey, Carter.
Hi, guys. Well, that's just it. There are potholes, and there's also what is perceived to be and really what is. And so one of the perceptions is that consumer discretion as a sector has been a great performer. And the reality is, of course, it's absolutely not a great performer. Let's try to unpack it. So 2 lines, blue and orange. The blue, this is since January of 18, so 18 months plus, up about 15%. And that's essentially double, if you look back at the axis there, the market. The market's up 7. The sector is up 15. So you say, so what's the problem? Now, it's always ever thus. It's a few names holding up the group, keeping everything alive. If you make the equal weight sector, let's add it in. So now all I've simply done is taken the blue line and not given Amazon the weight that it has in Home Depot and others, but made them all equal weight, 62 stocks, almost $3 trillion. And what we know is actually it's a big old goose egg. In fact, the sector itself up 15, equal weight unchanged, actually down a fraction. That's the real story of consumer, and it's what Dan was talking about with XRT. It's been with us a while, but it continues, and that's kind of the issue. So now here, removing the S&P, here are the two, the actual and then the equal. And one could say, so what? But the actual is the actual. But it makes it that much harder to outperform because you had to be in just a handful of names. In fact, and we can talk about this later, 5 names are half the weight of the sector. So a couple other ways to draw the lines. This is going back the same time frame. And what we know is that the equal weight sector, right, and its relative performance, and this is the problem, consumer discretion, equal weight relative to the actual is making new 2- and 3- and 4-year relative lows. Now, compare it to the S&P. Here's the equal weight on top, and it's the same thing, making new, fresh 52-week lows, despite the belief that the sector is outperforming. Pull this back even further. Here it is. We're approaching the 09 low. All of this for nothing, meaning the relative performance has collapsed we're getting back to crisis lows. And let's look at the two popular ETFs. This is the ETF, the weighted one. And what we know, there's no way around this, is that we're hovering, and the risk is that we break. And then, of course, here's the XRT, the disaster, and it's the same thing, just in a different form. It's a well-established downtrend. You can draw the lines and circles, and it all suggests more to come. Not good.
Carter, come on over. Jonah will bring the chair over. Thank you, Jonah. So many questions for Carter today, right?
A lot of questions.
I have a few.
Yeah.
You want to kick it off? Kick it off.
Why not? Why not? Well, first of all, welcome.
Thank you.
I guess my view is, while those charts don't inspire a lot of excitement, but the discretionary chart relative to Jan 2018, when all markets, when the U.S. market, the S&P at the all-time high, that blew off top, to me, it looks marginally better, and that would be an XLY, and that would be one which, again, includes a big boy like an Amazon or something that you're talking about. But is that a disaster? It seems like it's just performing in line, which we're really talking about relative performance.
Right. So I guess there's two ways. It's the circumstance where just a few names, in fact, 5 names, right, are worth half the weight. So 62 stocks, but 5, and you know the names, it's Amazon, it's Home Depot, it's Nike, it's McDonald's, and Starbucks, are basically carrying the day. And no one could say, wait a minute, so what? Macy's been going down for 5 years. JCPenney's been going. You're always going to sift out the winners and losers in life, and that these are the ones that should. But more and more money in fewer and fewer names is a circumstance that almost always ends badly, and that is the problem.
Sure.
So that means that the winners in the XRT, the 5 names that make up half the weight, are also going to be losers?
Well, ultimately, if you think about the circumstance of bifurcation, it's good technique. People say, I'm going to stay away from the things that aren't working, and it's musical chairs, and I'm going to go and stay in higher and higher ground. At some point, you just get to be a valuation issue. You just get to be a money flow issue, and we have to be very close to that point.
So, Carter, I'm curious. You come on week after week, you talk about these equal weighted, and you're saying there's only this narrow bunch of stocks that are working, and you go sector by sector, and it happens to be in every sector.
And you guys are talking about industrials with financials?
Right. So at what point does that become a huge problem for the market as a whole?
Well, that's just it. You have fewer and fewer.
You just fed him a softball, man.
What do you mean? I'm wondering if there's like precedent for this.
Dan was pounding on this just earlier. It is a circumstance that makes sense because as technique goes, you want to try to favor winners, but at some point, it's just too much money pressing in on too few names. Or guess what? It gets down to the fundamentals. At some point, they're expensive.
Has this been going on, though, for a long time?
It goes on and then it ebbs and it goes on and then it ebbs. And again, that's
so
the natural bias
in the ebb and flow
of markets. But it's particularly, poignant now, right? And it shows how fragile. It's a circumstance of fragility.
I want to ask you about the overall indices since we saw this sell-off in today's session. In your note this morning, you said June lows were in play.
I think so. I mean,
2022 or so?
Sure, you can do that, in an afternoon, But the point is that there's a breadth issue, and that's one of the reasons why you'll never hear me talk about advanced decline line. That is a concomitant index. It is a coincident index. What really matters is the structure of the market. The structure of the market is a lot of extended names and more weak names, and that bifurcation usually ends with generally lower prices.
Okay. Beyond 28-22, though?
I think so.
Beyond?
Oh, sure.
Why not? What, though?
Why not top it as the December lows and then some?
December lows.
Sure, why not? We're ultimately, unless you don't believe there'll ever be a recession again and the business cycle continues. I mean, if things were so good and rates were, you hear about the Fed model and my DCF and all the stuff that people, and you inverse the P, well, then stocks should be surging. We should have 30 times PE. Where are the buyers? Something's wrong.
Carter, thank you.
Thank you.
Mr. Sunshine here. Carter Braxton Ward.
Boy, you made some good points, though.
December lows.
Yeah, I would just make one point. I mean, so think about it. So farmers got the hardest hit, right, from this first round of tariffs that went in through last year. So now we're really starting to focus on the consumer here. So farmers got a bailout. Farmers got this really nice socialist chunk of cash that our manufacturers, right, we're paying for these tariffs, and then they got the money. So then pretty soon, consumers, they're going to need a bailout, right? And we bailed out consumers before. So if we keep ratcheting up these tariffs, are consumers going to get a bailout? And what do you think that means if we're just have these tariffs on 600 billion? Well, wait.
Tax cuts.
Well, first of all, if anything, I would be more worried about corporate America.
Yields actually have to go to zero and below. I mean, this is how it all starts.
Okay, but if anything, the place where there's an issue, when slow growth, the first place you're going to stop is actually that triple B tranche of debt that will very quickly turn to junk some of it
So
if you get a lower growth
environment.
So the falling angels is a dynamic. But back to your S&P, look, 2825 is the 50-week moving average. There's very good support there. Does not mean that has to hold. And in fact, your next spot is probably 27 and a quarter.